Hello and welcome to Must Read Research on B of A Global Research Unlocked. In this podcast, we offer quick summaries from the prior week's most interesting and impactful research. I'm TJ Thornton, Head of Product Marketing at B of A Global Research. I'm in for Candace Browning this week, and we're recording this episode on Monday, July 20th, 2026. The temperature is rising, and not just on the thermometer. This week, we examine a strong start to earnings season, a heated debate surrounding Netflix's engagement trends, how soaring European temperatures may make for sizzling corn prices, and then plunge into cooling foreign demand for U.S. Treasuries. Let's begin with earnings season, where expectations are high, but early results suggest companies may still have room to exceed them. The bar for 2Q earnings is high after 1Q delivered 27% S&P 500 EPS growth. But Savita Subramanian remains constructive, expecting a 5% beat versus consensus or 28% year-on-year growth. Tech should drive over half of growth, with semis expected to grow more than 130%, though breadth does extend beyond AI. We forecast growth for 10 of 11 sectors, with year-over-year growth of 121% in energy and 30% in materials. Results from early reporters are encouraging, with beats running above historical averages. Week one featured notable developments across several industries, including stronger than expected results from large banks, a medical loss ratio beat at United Healthcare, accelerating intermodal trends at J.B. Hunt, and a surprise negative pre-announcement from IBM that contributed to a record one-day share price decline of 25%. The three factors on our watch list are signs of lower income recovery, hyperscaler CapEx, and return on investment and earnings quality for those hyperscalers. From corporate earnings, let's turn to a company-specific debate where investors are questioning whether engagement trends can support the next phase of growth. Netflix shares are down more than 26% year-to-date and nearly 50% from their peak, including a 7% decline following largely inline headline results as investors debate slowing engagement, M&A risk, AI-driven content disruption, and rising competition from YouTube and other short-form platforms. Some investors point to declining viewing hours per subscriber, while more bullish investors note the company's ability to adapt its business model during previous periods of slower growth. Paid sharing and the ad-supported tier reignited growth when subscriber momentum stalled in 2022 and 2023, and management later proved margin concerns overdone through strong execution. Jessica Reif-Ehrlich notes that the platform now reaches more than 300 million subscribers globally, is generating significant free cash flow, and remains in the early stages of monetizing areas such as advertising, live events, and password sharing initiatives. High temperatures have had broader implications than just forcing hydration breaks this summer and may soon impact the price of our food too. Global agriculture markets are underpricing what increasingly looks like a structural weather risk premium, according to our global commodity strategy team. Global temperatures have exceeded pre-industrial levels by more than 1 degree Celsius every year for the past decade, while the Northern Hemisphere, home to 84% of global grain production and 76% of cotton output, continues to warm faster than its southern counterpart. Europe stands out, with temperatures having risen 0.87 degrees Celsius over the past decade versus 0.44 degrees globally. France produces 1/5 of Europe's corn and has already endured 2 heat waves with temperatures approaching 43 degrees Celsius, or about 109 degrees Fahrenheit, while Hungary is also showing severe crop stress. Our team estimates that losses in France and Hungary alone could cut EU corn production by approximately 10% year over year, driving record imports of 25 million tons. Yet Chicago corn has rallied only 8%. Widening the Matif-CBOT spread to a decade high. While nitrogen fertilizer has fallen back to pre-Iran conflict levels, elevated phosphate and potash prices, and the potential for additional Hormuz disruptions contribute to upside risks. Finally, let's move to the global climate for U.S. sovereign bonds. The supply-demand backdrop for U.S. Treasuries has become incrementally less supportive, even as U.S. fixed income flows improve. Foreign demand for Treasuries is softening. Japanese holdings of Treasuries are up only about $25 billion year to date and remain below 2024 levels, despite roughly 10% growth in the Treasury market over that same period. Furthermore, a potential Japanese public pension shift toward domestic assets could reduce future Treasury demand, which currently comprises about half the country's foreign bond holdings. Foreign participation in Treasury auctions has slipped to well below 20% from close to 25%, while foreign official custodial holdings continues to decline, contributing to ongoing discussion around future sources of demand and a potential diversification of reserve holdings. So from a strong start to earnings season, to the debate over streaming engagement, to weather-driven pressures in global agriculture, to softening foreign demand for U.S. Treasuries, these are a few of the themes shaping the conversation this week. Thanks for listening, and we'll be back next week.
Bank of America and B of A Securities are the marketing names for the global banking businesses and global markets businesses, which includes B of A Global Research of Bank of America Corporation. Lending, derivatives, and other commercial banking activities are performed globally by banking affiliates of Bank of America Corporation, including Bank of America N.A., member FDIC. Securities, trading, research, strategic advisory, and other investment banking and markets activities are performed globally by affiliates of Bank of America Corporation, including in the United States B of A Securities, Inc., a registered broker-dealer and member of FINRA and SIPC, and in other jurisdictions by locally registered entities. Copyright 2026 Bank of America Corporation, all rights reserved.